by looking at these, you can see why I believe, and I've said this for now since forever, that silver is the most undervalued asset on the planet. So it's a pretty simple to understand. I believe eventually we're going to see a few things happen. We're going to see again a debt market meltdown, which is going to pressure equity markets around the world. Where the bottom is with regard to the Dow, no one knows.
Welcome back to Soar Financially, everybody, where we discuss the macro to understand the micro a lot better. My name is Kai Hoffman. I'm the @JR Mining guy on Twitter and the CEO of the Soar Financial Group. Really appreciate your time joining us on a historic day. My guest called it in his videos or his updates on YouTube this morning. So I watched his trading update this morning, and he called it a historic day because we got a lot of news this morning on the macro side, and we're going to try to digest that together. It's Gregory Mannarino. Sorry, I butchered that one. That's awful. Apologize for that. Mannrino, he's first time guest on the program, so next time I'll have it down pat. And I really appreciate his time. He's a pro trader, obviously. You probably know him. He's all over YouTube and other channels as well. I follow him on YouTube as well. I'm a subscriber, so I like listening to his trading updates in the morning. And let me bring him on screen. I'm really looking forward to hearing from him today. And Greg, it's the first time on Soar Financially. Welcome to the program.
Thanks for having me. I'm very happy to be here, and this is going to be interesting.
It is going to be very interesting. Again, as I said, lots happened this morning just before market open. We got lots of news. Biggest news item probably last night in particular. And you called it a bit of a historic day today. And today is, by the way, August 2nd. So just to put some context around it, why is it a historic day? What happened?
Well, we lost our coveted AAA rating here in the United States. I mean, look, this is no surprise. This is just it's pathetic what we're seeing here, and it's not just a phenomenon here in the United States. I mean, it's enveloping the globe, and unfortunately, these are just the opening acts that we're seeing here. We have people don't understand it. I mean, and like we said pre-interview, most people don't care. We're watching a situation unfold on a global scale that is very difficult for people to get their heads around. And I think that's probably part of the reason why we're not seeing any kind of a real reaction, even in the markets, as we're talking about this kind of stuff. Most people are just so disconnected from all this. Unfortunately, they feel like it doesn't affect their lives, but it does. Obviously, the global economy is in a lot of trouble. The consumer is getting crushed on a global scale. We're all dealing with inflationary pressures, runaway central banks colluding with puppet governments everywhere you want to look at it. And unfortunately, I mean, this is all going to come around, and people are going to wake up. I think people are, some are, at least the people that follow our work, they're awake. They know what's going on. As we said pre-interview, we're preaching to the choir in many ways, but I think it's just so important to raise your awareness, understand what's going on, and then sitting back and saying, okay, everyone, what are we going to do about it? We're not just sitting here doing nothing. I hate to think, honestly, that people listen to our work and don't take action. They have to understand what's going on and what they need to do about it. It's not just, again, sitting back, listening to me blab day after day, over a decade now, and people, we're making a difference. I really think that people are starting to come around. They're understanding that there are problems. I really feel that, honestly, people are turning around a little bit. At least the people that follow our work are.
Yeah, I think so as well. Because if I look at the gold price, for example, and we'll get to commodities and precious metals I want to talk later about, but it's holding in there. So somebody is buying it. There has to be some retail buying that are just trying to protect their portfolio. That's my opinion, for example. So I see some evidence of that, right?
Mm-hmm.
But let's come back to the the macro picture for a moment here. Let's talk about the health of the economy overall. Because I look at the GDP in the U.S. and it's the highest of all the G7 nations. What is it? 2.4% GDP quarter over quarter and 2.6% year over year. That's insanely high.
These are the numbers that they want to fist feed us. But let's put this into another perspective. So let's take their numbers, for example. They're not even keeping up. The GDP numbers aren't even keeping up with the rate of inflation that they're letting us know about. So How does that work? It still shows us we're in a very dire situation. I mean, by their own numbers, we don't have to look at any other kind of numbers. Let's use their own numbers. Let's look at the GDP numbers based against inflation, and we're in contraction. And this is going to get worse. There's no doubt. I mean, look, the storyline, and it's just a fable from right out of the mouth of the propaganda ministry, the CNBCs, the Bloombergs, the Fox Business, all this stuff is, everything is fantastic. It's so, as a matter of fact, we are doing so well that our credit rating just got downgraded. Real wages continue to crater. I mean, based against inflation, what people are earning here. People's personal debt loads just are exploding. At the same time, we're seeing loan defaults rising at their fastest pace ever. This is how great we're doing, but it's all an illusion. This is why shows like this are so important for people to pay attention to understand that they're being absolutely propagandized by the programs on the freaking television. It's all nonsense. It's all fake. It's all scripted. You see, you and I, we're sitting here, we're just talking. I mean, right off the top of our head, we're going on what's happening here. And like I said, we're preaching to the choir, yes. But I think, people who watch our work say, at least these guys have kept us in the know. All the stuff that we cover, it's unfolding. I mean, I urge people to look at work that we've done in the past and what's going on now. You see, these guys told us. So this is why people aren't surprised or shocked. I ask people every day, even in my video this morning, how many of you are surprised about what you're seeing every day? And no one could be surprised because it's so easy to understand where we're going. It's a means to an end. It's cause and effect. And that's what's happening here, unfortunately.
Absolutely. Let's talk about the downgrade for a second and the impact, because we got a massive bond issuance ahead of us here as well. $1 trillion this quarter alone, at least another 500 to 800 billion next quarter. That's 1.8 max, like by the end of the year, if it stays that way. What does the downgrade have? How does that impact? Because timing, of course, is coincidental, right?
Nah. Well, this is supposed to be kind of here's my, you know what I think is going to happen? I'm going to tell you what I think is going to happen, because we've seen this time and time again here. We're going to see a miracle occur. We're going to start to see all of a sudden bond yields dropping. Oh yeah, this is just perfect. We're probably going to see some more propping up of the stock market back on the back of that as well. I mean, nothing would surprise me here. I don't believe that central banks are done propping up the system, keeping rates suppressed, regardless of what they throw at us. This debt downgrading should be a big deal. But as you can see, I mean, the market's negative right now. We have the 10-year yield here in the United States is at 4.06, I believe, last time I looked at it. We have the relative strength of the dollar stronger. It's the market is almost, I mean, seriously, even though the Dow is down triple digits as we're talking here, the market's almost shrugging it off. Again, we got the plunge protection team. The Federal Reserve buys the market. They do. I don't care what they may say. The fact that they tell us that they don't makes me believe that, of course, that they do. They do have a trading desk. That's a fact. New York Fed. So they need to prop this all up. I don't think they're done. I think we're going to see more distortions occur across the spectrum of asset classes. The debt market being the driver of this entire thing. It's just going to be more of the same until we're already seeing the effect of what central banks have been doing by soaring global inflation. The fact that we have eye-popping, this is not me, this is Market Watch, their headline yesterday, debt borrowing in this environment. It's not going to stop. It has to increase, as a matter of fact. It can't ever even remain static. This is what people don't understand for the most part, that just to sustain the now, we have to borrow more and more, exponentially more and more and more and more and more. It can't ever stop. People don't understand that the system itself is debt based, and it must be fueled with more and more debt on an ever growing basis. It can't stop. The moment we stop, we go back to freaking Mad Max. Sorry about that. Got my little pup over. He's mad. He's upset at what's going on. He can't even handle it.
Now he's looking at the bond yields. He's like, "What's happening here?" Or
he's like, "What's happening here? No. This shouldn't be going. I don't understand it. No, it's the truth. It looks a freak show. I've been saying this for the longest time. Nothing makes sense anymore. It doesn't. You can't look at this market from look, I'm an old school kind of old time guy, and I look at things and my brain kind of reverts sometimes, unfortunately, to the way things should be. But we don't have a real market anymore. There's no asset class today, in my view, that has a real price discovery mechanism behind it because of the unprecedented rigging of the debt market by central banks around the world who are coordinating this entire thing. It just doesn't make sense at all to an investor, to a trader, to anyone who has even the slightest understanding of this market. It doesn't make sense.
Yeah. Now I was looking at the market this morning. Before market open, it was all flat, and now the DXY is even up. US gets downgraded, the dollar goes up. Trying to understand that correlation. Does that make any sense to you? Like, what's your perspective on the US dollar in that regard?
Well, I still think the US dollar is going to remain the prettiest bell at the ball for the foreseeable future. Honestly, regardless of what's happening with BRIC nations and everything else, it's going to take a lot to dethrone the dollar, probably a global war. But with regard to the DXY or the dollar on a relative strength basis, it's going to remain the prettiest bell at the ball. Even, this debt downgrade here, if you think about the exposure other nations have around the world to U.S. debt, to the U.S. dollar, I could kind of understand why it's happening to a certain degree. It's going to be like this. It's going to remain this way I really feel for an extended period of time. But this does not, people don't discern generally looking at the relative dollar strength. I like to look at it on an absolute strength basis. You can look at the relative or comparative strength, and again, the dollar is going to remain the prettiest bell of the ball. And then you got on the other side the absolute strength of not just the dollar, but of every fiat or central bank issued currency. They're all losing purchasing power here as the global debt expands, as central banks, literally, in my opinion, I've been saying this for 10 years, are deliberately killing their own currencies here. And we're seeing the side effects of it. I mean, you can't just create cash out of nothing. All central banks are doing this to buy assets and not have a side effect or an effect of it. It's a cause and effect like everything else is. But, people don't know this stuff. They have no idea of how the system works at all. So this is why they disconnect themselves. And I think when people are presented with, let's say, something that they feel is too complicated, or gives them a headache to think about it, they don't think about it. And this is why we're not having such an overwhelming response, I think. But it's going to come. And eventually, again, I'm going to tell people how I believe it's going to play out. And you probably understand it. Is we're going to get a meltdown here in the debt market at one point. Debt market is going to melt down. Yields are going to spike in an uncontrolled fashion. That's going to destroy global stock markets. And cash is just going to move. It's going to move into commodities. And I also believe into cryptocurrencies as well. It's going to look for places to go. It may go into things like artwork as well, musical instruments, classic cars. I mean, it's just going to look for places to go, and it is already. I mean, just looking at. I'm a old car enthusiast. Look at the prices of classic cars as of late. They have gone absolutely parabolic. Artwork, musical instruments as well. All of these things, old musical instruments, vintage stuff, they just taken off. So you have already this phenomenon of cash-seeking alternatives. Unfortunately or fortunately, depending on how you want to look at it, you have the price of gold and silver here. Sorry about that again. You see, he's all angry. Getting it's artificially suppressed. We all understand the game, how it's played. You have the paper derivative dictating the price of the hard asset. It's upside down. And but that gives us opportunity, all of us. I mean, I think I've been telling people since literally for over a decade that they need to be in hard assets, commodities, more specifically physical silver. I really feel that I'll never change. I really feel that how I'm outlining this is how it's unfolding, and how it's going to continue to unfold moving forward.
Just want to hone in for one more second here. Just stay on topic here. I'm just looking at the bond yields. They're like the 6-month at 5.5%, the 10-year at 4.09. You mentioned.
Isn't that lovely? How it works like that?
Like,
the inverted yield curve.
Right,
please, people, everyone ignore that too.
So we're pretty much in a real yield environment if you take the official inflation rate of 3%, right? Would you buy bonds right now? Like you expect a spike in a breakdown, but are we getting to, like, I don't know, I'm looking at 5.5%. That's a decent yield on a bond. Like if I buy it and hold till maturity, it's like I'm not a trader. If I buy, I hold, right, until it gets paid out. So is that something you would buy right now? Is that or do you stay far, far away from that?
No, I wouldn't buy that right now. I think again, going back to what I was saying, I people are going to hate me for saying this, but I've been telling people for the longest time to stay long this market here. I've been net long this stock market for a very, very long time. I don't think they're done. I don't think they're done. I believe we're going to still continue to see rates yield suppression here. And what does it do? Let's just explain a very, very basic premise that most people don't understand here. When central banks get in here and they artificially suppress bond yields, what does it do? What is the effect of that? What are they intending to do by keeping rates suppressed? What it does is it opens up a doorway for cash to make its way into risk assets or equities or stocks. This has obviously hyperinflated a new stock market bubble, a real estate bubble, and caused distortions again across the spectrum of asset classes. There's not an asset today that has a real price discovery mechanism behind it. I don't think people want to be if we are expecting, you and I, at least I am, that eventually we're going to get a debt market meltdown here, and no one can predict when this is going to happen. I mean, it's an impossibility. It's going to be at a time of their choosing. They're going to keep buying the debt. They're going to keep rates suppressed, central banks collectively. I don't think being in a bond here is the right place to be. I think people need exposure to the long end of the market in, let's say, an exchange traded fund that was paying them a nice big fat dividend, and at the same time giving them exposure to the long end of the market until we see an uncontrolled spiking in the 10-year yield, which is the benchmark. You know that here. That's when we run for the hills, and we're not seeing that yet. With this action is very interesting. Okay, it's very interesting. Over the past several days, I have an indicator called the MMRI, the Mannrino Market Risk Indicator. It's free to anyone who wants to pay attention to it. It's right on my website, traderschoice.net. We've watched this thing bounce around for quite a while. When I created the MMRI, we were down in the 60s. Today we were over 250. This morning I think we were 260 last time I looked at it. And every time, as of late, that we've crossed 250, we've seen what we're seeing now. Markets falling under pressure. It measures risk in the market in real time. It's very, very simple. It looks at the relative strength of the dollar. It looks at the 10-year yield, the cute little mathematical equation here, and it comes up with a number. And this has been dead on accurate. So what I'm looking at here, instead of just focusing on, let's say, the relative strength of the dollar, or I'm looking at the 10-year yield, I'm looking at the MMRI, and it's really a fantastic indicator. Again, I don't charge for anything; it's free. It's for everyone. So I'm not selling nothing. I want people to just pay attention to it. And this is a great indicator, I think, of where we are going. Looking at, for example, you look at leading economic indicators talking about the economy. Every single one of them is pointing lower. We got an inverted yield curve, the most we've ever seen in history. And again, don't take my word for this, anyone paying attention to this, but if you look at the yield curve, and again, we've never been here before, but this kind of a thing has preceded every single recession in history. And I think we're already in recession. I think we're going to something much worse than recession, not just here in the United States. It's going to be around the world. I mean, this is going to affect everything. Central banks know exactly what they're doing. They're doing this incrementally, step by step. They're bringing the global economy to its knees. Central bank's goal is to become the lenders and buyers of last resort. That's probably why we're not seeing a crazy reaction here in the debt market or in the stock market right now. Who knows? Maybe we will tomorrow. But I believe that the markets believe that there's going to be some kind of intervention. And I've been telling people this for days, that expect to see some kind of direct intervention, in this case by the Federal Reserve, to push the 10-year yield down, buy more debt, find a way to weaken the dollar on a relative strength basis, or they're going to get into the market and start buying stocks. They buy large cap stocks, they prop up the market. It's known as the plunge protection team. It's a real thing. I urge people to look it up as well.
Now, interesting. You mentioned something that reminded me a bit of Japan, where the Fed is the buyer and seller of treasuries. Pretty much, they buy their own stuff, their own product, right? And their debt to GDP ratio is close to 2. I wrote it down actually, 263. The U.S. is at 129, right? So let's say the U.S. is at half of where Japan is. Do you see the U.S. spiraling towards Japanese levels here? And what would that look like?
Well, let's think about it. What do people believe is more likely to happen? You see that this is how I look at things like this. Okay, what is the most likely situation to unfold? Are we going to actually get some kind of real spending cuts, or are our politicians colluding with central banks more likely to continue to inflate, or at least try to inflate out of it, which is an impossibility? So my bet, and I believe that 99% of the people who are listening to this are going to agree, they're going to continue to inflate. So we're going to see more of this here. What people also don't understand, and is central banks, how they keep their control on all of us is by their ability to inflate, create more debt. Do you remember during the whole debt ceiling escapade over here, the worry on the face of Janet Yellen? Oh, no, we need to do this again, because the nanosecond that we can prevent a central bank from issuing more debt, even $1, the entire global central banking system starts to die. Now, they will not allow that to happen. Central banks are in control. Central banks are the government. And everything else is just a sideshow. So to answer your question, yes, this is going to spiral way more out of control here. And that means, obviously, inflationary pressures are going to get much worse moving forward. I don't care look, central banks have been pushing the biggest farce probably in financial history, one of the biggest pieces of charades on the people of the world here. Oh, yes, we're going to raise rates. Raising rates is going to eventually, cause a miracle, and inflation is going to drop. No, it's not even meant to do that. All this does is cut off the availability of credit. They're crushing small businesses here by design, crushing the consumer by design, and fulfilling a corporate agenda. This is what I told people since day one. It's proven to be true. And then, the more you hear from the mainstream how things are getting better, frankly, how much worse they actually are getting, because all you can get from the propaganda ministry is lie after lie and deception and distraction. Again, thankfully, there are shows like this where people can get the truth.
Yeah, no, absolutely. And we really like that as well, because it just keeps things real as well. I'm just looking here. Reuters put out a report. U.S. banks are reporting tighter credit, weaker loan demand. It's exactly what you're saying.
Of course, that's just sort of, I've been telling, this is what they're doing. I mean, you got to be blind not to understand this. And again, this is no surprise to you, to people that follow our work. I've been explaining that this exact phenomenon was going to unfold. That's what it's all about. They're cutting off credit. They're making it harder for small businesses who function on a day-to-day basis by being able to take out loans and then pay off those loans and take out loans and blah, blah, blah. It goes on and on. But these big corporations, they're awash with cash, and they know that. So all this is doing is fulfilling the corporate agenda, period. It's hideous to me. But again, where's the outcry? Where is the revolution? It's nowhere. And that the silence is very it's just a terrible thing to see.
Yeah, we're killing Main Street, the mom and pop shops that that need credit to survive, because they need to borrow to produce goods, right? No, that's it's not a pretty picture we're painting here. But one thing you said I want to come back to now is you mentioned people need to own real assets, hard assets, and you mentioned silver in particular, not gold. So I need to follow up with you on this. Why silver, and what kind of ratio to gold would you own there?
Look, I'm a simple guy. I try to keep things very, very simple. And what I want people to do always is their own homework. All right. I want people who are watching this video right now to do one thing, and they can open up a search engine as they're listening to this. Look at the Dow Jones Industrial Average gold ratio and the gold silver ratio. But by looking at these, you can see why I believe, and I've said this for now since forever, that silver is the most undervalued asset on the planet. So it's a pretty simple to understand. I believe eventually we're going to see a few things happen. We're going to see again a debt market meltdown, which is going to pressure equity markets around the world. Where the bottom is with regard to the Dow, no one knows. What we do know is the Fed jumped in here at Dow 6,000 to start quantitative easing one. So the real bottom of this market could be Dow 6,000, could be lower. Let's just say it's 6,000. I think we're going to see a 1-to-1 ratio to the Dow Jones Industrial Average and gold, and maybe a 15-to-1 or maybe even a 10-to-1. gold to silver. So, I mean, just do the math. It doesn't take a lot to figure this out. And you can see why I believe that. And commodities are real things. So what's going to end up happening? See, markets are supposed to run in cycles. Okay. They're supposed to do this. Although today, this market seems to do nothing but go higher up until very recently when the MMRI crossed 250 for the bunch time. And every time this happens, it seems like the market takes a hit. But generally, you know, you get corrections and you get pullbacks. We don't see this anymore, but eventually this is all going to turn around. We got a risk-on cycle, meaning cash deliberately making its way into the equity market via suppressed rates. When rates spike, and they're going to, we're going to get a meltdown in that debt market. It's a matter of time. You're going to get the meltdown here. You're going to get cash bleeding out of the debt market, cash bleeding out of the stock market. It's just going to move. Cash does not fly away to money heaven. It doesn't grow little wings and fly away. It just moves from one set of assets into another. It's very simple to understand. And I believe we're going to see an ocean of cash make its way into commodities when all of this stuff melts down. And again, other assets, and we're starting to see that again with classic cars and classic instruments and artwork and stuff like that too. So it's just a matter of time. So right now, I think is just opportunity. You know, you can look at all this stuff and say, oh my goodness, it's all doom and it's gloom, but it's really not. It's about opportunity. As we started the video off, it's about people taking action, but doing their own research too. Don't listen to a damn thing I'm saying without understanding it, doing your own research. And then if you come to the conclusion that, hey, Greg Mannarino is actually right, then you take action, of course. I mean, I don't want anyone to jump into anything they don't understand. That you have to understand what you're doing before you do it, quite obviously.
No, absolutely. Silver, we had a guest on yesterday, Julian Brigden of MI2 Partners. I'm not sure if you're aware of him or know of him, but he said silver's the anti-dollar. The perfect, anti-bet to the dollar. And if, if we do predict a market meltdown, I think the dollar is going to suffer as well, and silver should spike. Right?
Well, the dollar's a unit of debt. That's all it is. These dollars that we hold in our bank accounts and our wallets, we don't even own them. These they're owned by the issuing central bank, in this case, the Fed, and they're owed back to the Federal Reserve plus interest that they create out of nothing. All people work for is the ability to borrow those dollars from the Federal Reserve in whatever form they may exist, more than likely digital. But anyway, that's it's a crazy concept to understand that central banks control the economy, they control the financial markets, they control the financial system. So henceforth, they control the world. The rest of it doesn't matter anymore.
No, interesting comment there. Greg, I can't let you go without asking, what are you trading these days? I had Todd Bubba Horowitz on the other day, and he said, well, I'm sending my readers and subscribers to the pool. Don't trade anything. They have their long positions, but they're not trading right now because volumes are down, liquidity is missing. They're not a lot of impact or impacts like action items on his agenda right now. So what are you doing these days?
Well, a bunch of things that people. What I do is I tell people what I'm doing pretty much. Right, this is what people, and that was your question. So this is what people need to do. People need to, again, bet against the debt, become their own central bank. I've been telling this people since I started, since day one, meaning hold hard assets. Okay, physical silver, my favorite asset of all time. I'm not saying people should go all in on any one asset, but I think people need to be somewhat diversified. For now, people should be on the long end of this market. I own an ETF, ticker JEPI. I own a lot of it. I intend to buy more. This pays, the dividend varies. Right now, it's just over 10% per year, and you get paid per month, that dividend. And it also gives you exposure to the long end of the market. I happen to like that right now. I am looking for opportunities to buy more, believe it or not, because I don't believe central banks are done in inflating here. So commodities, absolutely. And I'm going to say this too. I don't know how many people are going to hate me for saying this, but I think people need some exposure to cryptocurrencies. Pick one, pick Bitcoin. I don't know. That's the mother of them all. I think, again, in a meltdown situation, which is going to occur, you're going to see this cash look for places to go. And one of them is going to be cryptos as well. Commodities, 100%. I have a free newsletter. And people can access that from my website there. I've been putting out list after list after list of exchange traded funds, which will allow people exposure to commodities. Some of these even pay dividends. It's a nice situation. What's the easiest way to take advantage of this? Silver. All right. I'm gonna say it again for the gazillionth time. People need to hoard this stuff. They need to stack it in the corners of their house or put it in some kind of a safe or a safe place. But you need commodity exposure. Look, this market and all that is involved in it, it's not for everyone. I get that, but you need to take action and at least understand why you got to be on the opposite side of this debt hyper bubble. In the dollar is obviously a unit of debt here. Got to get out of that. Convert those dollars that are sitting in your bank account that you don't even own anyway, into hard assets, silver again. So, that's kind of where I stand. I'm a pretty simple guy, like I said. And people, I tell people everything that I'm doing. Pay attention to what I'm doing. You can find me on my website. I'm pretty easy to find. Just Google me. I'm kind of everywhere.
Fantastic. Yeah, I was going to wrap up the conversation with where can we find more of you, but we have your website here on screen, traderschoice.net. I know you're on Twitter. You're super active on YouTube, obviously. 230,000 subscribers that are following you there as well, and your trading advice. So fantastic. Greg, thank you so much for your time. Really, really enjoyed the conversation, and yeah, much appreciated. Let's do this again soon.
Absolutely. It was. I hope people pay attention, honestly.
I do as well. Lots going on here. So let's great to put some context around it. I truly hope you enjoyed this conversation with Greg here. Make sure you subscribe to the channel because I know 80% of you are not subscribed that are watching. Let's change that. I want to bring guests like Greg back on the channel more frequently if possible as well, and we can bring some other calibers on as well. Really appreciate that support. If you have a question, leave that down in the comments. Engage with us. We want to hear from you. How are you trading the current scenarios? Are you buying bonds? You're really curious. 5.5%, is that something you laugh at, or are you waiting for 6, 7, or 8%? Let me know. I do want to hear from you. Thank you so much for tuning in, and we'll be back with lots more.